Section 140, Section 45, subsection 1A. We are going to discuss computation of capital gains under special circumstances. Computation of capital gains under special circumstances. There, first we are going to discuss 45 subsection 1A. Applicability capital asset is destroyed or damaged and the reason for destruction or damage or damage should be A. Flood, B. Typhoon, hurricane, cyclone, earthquake, any other convulsion of nature riots, civil disturbance, accidental fire, accidental explosion, action by enemy, IJKL, action taken in combating the enemy, action taken in combating the enemy. The reason for destruction should be these. Condition number 3, the capital asset is insured. The capital asset is insured. If these conditions are satisfied, what is the impact? Section 45 subsection 1a gets invoked. What it says? Capital gain shall be charged to tax. Capital gain shall be charged to tax. On account of destruction or damage of capital asset. Capital gain shall be charged to tax on account of destruction or damage of the capital asset. For this purpose, previous year of transfer is the previous year of destruction or damage. Previous year of chargeability of capital gains is the previous year in which compensation is received. The previous year in which the compensation is received. Period of holding ends on the day preceding the date of destruction or damage. The full value of consideration is the compensation received. Is the compensation received. Here, if the capital asset destroyed or damaged is a depreciable asset. Is not a depreciable asset. If it is a depreciable asset, it will always result in short-term capital gains. Short-term capital gains shall be computed within the parameters of section 50, which I will be discussing subsequently. within the parameters of section 50. If the asset destroyed or damaged, it is a non-depreciable asset. Capital gain is computed under 48. Space is not there. If the gain is long term, indexation is to be done. For that, numerator index, INN numerator index. Index relating to the previous year of destruction or damage. Previous year of destruction or damage. Previous year of destruction or damage. This is how we do compute capital gains. So previous year of transfer is what? Previous year of destruction. That's the reason why the numerator index is index pertaining to the year of destruction. However, the capital gain is computed in which year? We compute in the year in which the compensation is received. And the period of holding, it ends on the day preceding the date of destruction or damage. The full value of consideration is the compensation received. If the asset destroyed or damaged is a depreciable asset, we compute short-term capital gains within the parameters of 50. Non-depreciable asset, we compute capital gains which may be long-term or short-term under 48. And if the gain is long-term, indexation comes, numerator indexes. Index relating to the year of transfer, which is the year of destruction or damage. With this, we are through with section 45, subsection 1A. Subsection 1A. Next is section 45 subsection 2. 45 subsection 2. Assessee converts capital asset into stock in trade. Assessee converts capital asset into stock in trade. In the previous year of conversion, there is no tax implication. There is no tax implication. In the previous year of conversion, there is no tax implication. But the previous year in which the stock in trade is sold. How to read this? Previous year in which stock in trade is sold. There will be tax implications under two heads. There will be tax implications under how many heads? Two heads. One under the head capital gains, another under the head PGBP. There will be tax implications under two heads. One is under the head capital gains, another is under the head PGBP. First, tax implications under the head capital gains Papa. What it says? Number one, conversion of capital asset into stock in trade, asset in a stock in trade, is transfer, which we studied as per section 2 class 47. This is first point. Point number 2, previous year of transfer is previous year of conversion. Previous year of conversion. But the capital gain is chargeable not in the year of conversion. The previous year of chargeability is the previous year in which the stock in trade is sold. Previous year of chargeability is the previous year in which the stock in trade is sold. Period of holding ends on the day preceding the date of conversion, because conversion is transfer, date of conversion is date of transfer. It ends on the day preceding the date of conversion. Full value of consideration is fair market value on the date of conversion. Fair market value on the date of conversion. If it is long-term capital gain, indexation has to be made. INN numerator index. Numerator index is index leading to the year of transfer. But here transfer is conversion. So index leading to the previous year of conversion. Index leading to the previous year of conversion. Index leading to the previous year of conversion. These are all the aspects you need to note. And you need to compute capital gains. Tax implications under the head PGBP. Stock in trade is sold, na? The resultant gain shall come under the head PGBP. Tax implication. The difference between the sale price of stock in trade and the fair market value on the date of conversion this is taxable under the head PGBP in the previous year of sale of stock in trade. It is taxable in the previous year of sale of stock in trade under which head? PGBP. So, sale price of stock in trade minus fair market value on the rate of conversion. This is taxable under which head? Taxable under the head PGBP in which year? The previous year of sale of stock in trade. In the previous year of sale of stock in trade, it is taxable. So, thus, there are two heads under which there will be implication. One under the head capital gains, another under the head PGBP. Consolidate where capital asset is converted by the assessee into stock in trade. In the year of conversion, there is no tax implication. So, in the year in which the stock in trade is sold, there will be implication both under the head capital gains and under the head PGBP. Under the head capital gains, implications are as under conversion of capital asset into stock in trade is transfer. Previous year of transfer is previous year of conversion. Previous year of chargeability is the year in which stock in trade is sold. Period of holding ends on the day preceding the date of conversion. Fair market value on the date of conversion is full value of consideration. And numerator index is index leading to the previous year of conversion. Tax implication under the head PGBP. Sale price of stock in trade minus fair market value on the date of conversion. This is taxable under the head PGBP in the previous year of sale of stock in trade. Now, I'll give you one example for understanding this, or illustration for understanding this. Illustration. X is the assessee converts land which was treating it as capital asset into stock in trade. Converts capital asset into stock in trade. Rate of conversion first June 2018. Fair market value on 1st June 2018 is 100 lakhs. When he acquired this as capital asset, cost of acquisition was 20 lakhs. 1st January 1999 is the date of acquisition. Fair market value as on 1st April 2001, 30 lakhs. Then the stock in trade is sold on 1st June 2019 for 130 lakhs. These are already details available. First, the previous year 1819, assessment year 1920, there is no tax implications. That is the year of conversion. In that year, there is no tax implications. Come to the hands of X, no tax implications. In the year 1920, assessment day 2021, that is the previous year in which stock in trade is sold. Tax implications. Under the head capital gains, tax implications under the head PGBP. Tax implications under the head capital gains. First, period of holding starts on 1st January 1999. It ends on the day preceding the date of conversion. Conversion 1st June 2018. One day before is 31st May 2018. This is the period of holding. This period of holding more than 24 months. Why? Immovable property. Nature of capital gain is long-term capital gain. Full value of consideration is fair market value on the date of conversion, 100. Fair market value on the date of conversion. Indexed cost of acquisition is cost of acquisition. First we should determine if the asset was acquired before 1st April 2001, we are having option to take FMV, fair market value, as on 1st April 2001. Cost of acquisition 30 lakhs into numerator index index pertaining to the year of transfer. Year of transfer is the year of conversion. Year of conversion is 1819. 1819 index is 280. 280. 280 is the index pertaining to the year of conversion, which is 1819 index divided by base index, because the asset was acquired before 1st April 2001. The indexed cost of acquisition is equal to 30 into 280 divided by 100. 84 lakhs. There is long term capital gain 3 minus 4. 16 lakhs. 16 lakhs is the long term capital gain. Now we need to compute tax implications under the head PGBP, where first point, sale price of the stock in trade. The stock in trade is sold for 130 lakhs. Now we need to reduce the fair market value on the date of conversion. Which is 100 lakhs. Balance is income under the head PGBP. This is taxable under the head PGBP. So this is how the problem is to be solved. This is section 45(2). Next is, there are connected points here. Note. Assessee converts stock in trade into capital asset. Converts stock in trade into capital asset. In this case, we will have tax implications. We will have tax implications where there is conversion of what stock in trade into capital asset. And subsequently, the capital asset is sold. There will be tax implications. In the previous year of conversion, the difference between fair market value on the date of conversion and the carrying amount of stock in trade is getting taxed under the head PGBP. It is taxable under the head PGBP. Taxable under the head PGBP. Number 1. In the previous year of conversion, the difference between fair market value and the rate of conversion, the carrying amount gets taxed under the head PGBP. Then this is by virtue of section 2, class 24, subclass 12A, read with 28, class 6A, read with class 28, 6A. Now, in the previous year in which the capital asset is transferred, the previous year of transfer of capital asset, the tax implications are as under. Number 1, we need to compute capital gains. For that, capital gain needs to be computed. For that, we need to know the cost of acquisition. For that, we should know the cost of acquisition. Cost of acquisition is fair market value on the rate of conversion. Fair market value on the rate of conversion. Where it is given 49 subsection 9. Cost of acquisition is fair market value on the date of conversion. This is cost of acquisition. The period of holding starts on the date of conversion. Period of holding starts on the date of conversion. This is 242A. Explanation 1. Class BA. Period of holding starts on the date of conversion. If the gain is long term, we need to do indexation. There, ID means denominator index. Index relating to the previous year of conversion. Index relating to the previous year of conversion. Denominator index is index pertaining to the previous year of conversion. Previous year of conversion. This is how we need to compute capital gains in the year in which the capital asset is transferred. Fine. This is how the capital asset is to be, the capital gain is to be computed. Then we have one provision 43, class 1, explanation 1A, explanation 1A. Section the converted capital asset is used in the business converted capital asset is used in the business carried on by the assessee. Then it is eligible for depreciation. It is eligible for depreciation. For that purpose, the actual cost is fair market value on the rate of conversion. For that, actual cost is fair market value on the rate of conversion. To visualize, I will give you one example. Assessee is X. He is in real estate business. He is converting a flat from stock in trade to capital asset. This flat is to be used as administrative building for his business. Is to be used as administrative building for his business. Converts a flat from stock in trade to capital asset. It is to be used as administrative building for his business. The cost of construction of the flat $40 lakhs. Fair market value and the rate of conversion. $80 lakhs. The tax implications are as under. Tax implications. $80 lakhs FMV minus 40 lakhs cost. This 40 lakhs is taxed under the head PGBP. Actual cost of flat for the purpose of depreciation. is 80 lakhs, being fair market value on the rate of conversion. This is the fair market value on the rate of conversion. This is based on explanation 1A to 43.1. So this you need to note. Converted capital asset is used in the business carried on by the associate, is eligible for depreciation. Then the actual cost is the fair market value on the date of conversion. For that only I have given the example. So we are discussing about the reverse scenario of converting stock in trade into capital asset. Now section 45.3. What is 45.3? A person who is a partner in a firm he is transferring a capital asset to the firm transfers capital asset by way of capital contribution by way of capital contribution then in this case tax implications in the hands of partner. Capital gain needs to be computed in the previous year of transfer. Transfers capital asset by way of capital contribution or otherwise. Capital gain needs to be charged to tax in the previous year of transfer. Full value of consideration is the amount at which the capital asset is recorded in the books of firm. Amount at which asset is recorded in the books of the firm note 1. So we should take the amount at which the asset is recorded in the books of the firm for computing capital gains in the hands of the partner. Subsequently, if the firm transfers such capital asset subsequently if the firm transfers such capital asset the cost of acquisition for computing capital gains shall be the amount at which the capital asset was recorded the books of the firm. Subsequently, the firm transfers such capital asset, the cost of acquisition for computing capital gains shall be the amount at which the capital asset was recorded in the books of accounts of the firm. Note 2. Provisions of section 45(3) shall equally apply when a member of AOP transfers his capital asset to the AOP by way of capital contribution or otherwise. So, provisions of 45(3) shall equally apply when a member of AOP transfers his capital asset to the AOP by way of capital contribution or otherwise. This should be understood. So, with this, we are through with 45(3). Next is 45(4). Where a firm distributes capital assets to its partners, where a firm distributes capital asset to its partners upon dissolution upon change in constitution Suppose if a partner retires, there is change in constitution. The firm distributes capital assets to its partners upon dissolution or change in constitution. Tax implications in the hands of firm. We are discussing what tax implications in the hands of the firm. Capital gain needs to be computed in the hands of firm. In accordance with section 45(4) read with 48. In accordance with section 45(4) read with section 48. There, first step, previous year of transfer is the previous year of distribution. That is the year of chargeability. Full value of consideration is fair market value on the date of distribution. Fair market value on the date of distribution. Note 1. Subsequently, the partner transfers such capital asset for computing capital gains in his hands. Capital gains in his hands. The cost of acquisition is the value mutually placed on such asset by the partners recorded in the dissolution deed. Subsequently, if the partner transfers such capital asset for computing capital gains in his hands, the cost of acquisition is the value mutually placed on such asset by the partners recorded in the dissolution deed. Note number 2. Provisions of 45(4) shall equally apply when an AOP distributes its capital assets to its members upon dissolution or otherwise. Upon dissolution or otherwise. This is 45.4. 45.4. Next is (45.2a). Capital address asset transferred is dematted securities. Then cost of acquisition and period of holding shall be determined on FIFO basis. Cost of acquisition and period of holding shall be determined on what basis? FIFO basis. Dematted securities, they have no physical form. When they don't have physical form, so it is difficult to track the lot that is sold. So very difficult to ascertain the cost of acquisition and period of holding. For that, guidance is given in 45.2a, which says you quantify on FIFO basis. Assess is X, is having shares in Reliance, which is in demat form. The demat account extract I am giving. Demat account extract I am giving. June 2017, 1000 shares were purchased at 900 per share. February 2018, 1500 more shares were purchased at 1000 per share. 6th May 2018, 1000 shares were purchased at 850 per share. These represents purchases, different dates. 19 September 2019, 2200 shares are sold for 1200 per share. Now in this case, for these 1200 shares, we need to compute capital gains. For that we need to know the cost of acquisition. 2200, sorry. These 2200 shares we are dividing into 2. This is lot 1, lot 2, lot 3. 1000 shares are out of lot 1. Thousand 200 shares out of lot 2. Space is not there. A, B. For these 1000 shares, cost of acquisition is 1000 into 900. First lot 900. FIFO na. Period of holding starts on 5th June. It ends on 1 day prior to the date of transfer, 18th September 2019. This is period of holding. We have decided on FIFO basis. For this, cost of acquisition is 1000. 200 into 1000. For this, period of holding starts on 8th February 2018. It goes up to 18th September 2019. This is the period of holding. This is I should say this is B and this is A. For A, this is the cost, this is the period of holding. For B, this is the cost, this is the period of holding. Determined on FIFO basis. One line summary. Demat as securities, if they are transferred, since they have no physical form, we need to determine the cost of acquisition and period of holding on FIFO basis. On FIFO basis. We'll stop here. We'll continue in the next class.